We need to accept the stock market is tough to beat. Why is that? The financial press in particular tell us that there are fund managers who regularly beat stock market returns and you should be investing in those funds. The outperformance is usually explained by the fund manager as down to their stock selection skills. They pick higher return stocks over lower return stocks. Equally, it could be down to market timing decisions. They buy the market when it's low, they sell the markets when it's high, but before a market crash. Many fund managers use a combination of both stock picking and market timing decisions. The reality of fund manager performance, however, is somewhat different to what we read in the financial press and what the fund management industry leads us to believe. Ongoing studies on fund manager performance show that over the longer term, the vast majority of fund managers underperform stock market returns, at least by a function of the costs they incur and their own management charges. Sure, over shorter term periods, some fund managers do generate returns better than the stock market. But again, the studies show that outperformance rarely persists over longer periods of time. And the repeat success rate of fund managers outperforming is no different to what we would expect by chance. In other words, some fund managers just get lucky with their performance over shorter term time periods. The results of the studies hold the world over for the stock markets of developed economies such as the UK, US, Europe and so on, but also the stock markets of less developed economies such as the emerging markets. So why is the stock market so tough to beat? Well, there are a number of reasons, all of which revolve around the changing nature of stock markets over the last 50 years or so. The heart of the problem is that investors fail to realise that the stock market consists of thousands and thousands of participants, all buying and selling and setting the prices of stocks. New information comes to the markets on company earnings, broader economic issues, geopolitical issues and so on, and is almost instantaneously reflected in stock prices as market participants trade to adjust the prices of stocks accordingly. This is what we call market efficiency. So, to generate a return better than the market and all of its collective wisdom, you need to know something that the rest of the market doesn't know. The chances of this, however, are extremely low. What's more, even if you are successful once, you then need to repeat your success rate at least often enough to offset your costs for the research and trading you are conducting. The problem of beating stock markets gets tougher for both individuals and fund managers alike. For a start, from the period post the Second World War, 90% of stocks at that time were owned by individuals and just 10% by institutions such as pension funds. Today that ratio is reversed. 90% of market participants are institutions, that's pension funds, sovereign wealth funds, hedge funds and so on, and only 10% of the market is now owned by private individuals. So as an individual investor today, you're trading your knowledge against all of the collective expertise and resources of professional fund managers in the main. Meanwhile, the professional fund managers are equally having it as tough. For a start, there's a lot more money chasing around for market returns. Whilst the fund managers themselves, they all have PhDs in finance, in mathematics, nuclear physics and so on, and they're backed up by high-speed computers set up to search for pricing anomalies amongst their trades. This paradox of skill means it also has become harder and harder to outperform, as the fund managers are largely now pitted against each other most of the time, not against less well-informed individual investors. We see this paradox of skill in the world of sport. For instance, top-seeded tennis players have a higher win rate during their opening rounds of a tournament as they are pitted against the lower seeds, but their win rates drop as they hit the final rounds of a tournament in the semi-finals and finals when they're pitted against the best players. The same thing is happening in the fund management industry. All of these factors together, market efficiency, the speed with which information is embedded into market prices, the changing nature of the market participants, and the paradox of skill, when added together, all make stock market returns tough to beat.